Hey guys, thank you for watching this video. Don't forget to hit that thumbs up and subscribe. I'm putting out at least one video a week, giving you guys absolutely free content that's gonna help you guys, whether it's long-term, short-term, just in finance and everything like that. So with that being said, let's jump back to the video. What is going on, everybody? Welcome back to another dividend video. And this one is going to be a little bit of a different one because we're going to compare a couple of stocks that are both very, very popular. So one being Coca-Cola. Everybody knows the brand Coke. It's a huge legacy brand. Warren Buffett invests into it. He's one of the biggest investors. This single company right here made investors in that town absolutely just filthy rich, and that's absolutely awesome. But what's the other one that we're going to compare it to? We're going to compare it to QYLD. And why? And that's because this is one of the most popular income funds, using covered call to create income every single month. You guys know I'm a huge fan of those monthly dividends and stuff like that. But how does it compare to just a solid company that's going to pay me a quarterly dividend versus a monthly dividend? And we're going to go into this one because I want to at least show you guys, and you have to pay for all this stuff, but we don't really care about that. We just want to see what it's going to pay every month. About 40 cents. And if you go to the max, of course, it's going to have a ton. They started out paying 3 cents a quarter, and now they're up to 42 cents a quarter, which is not bad whatsoever. But are they going to give you that compounding that you're really looking for? And I think that's something that everybody really needs to look at. And yes, if you look at the 1 year, of course, everything has gone up in the past year, 2 years, ever since the crash. So let's go on ahead, and you guys know the tool we're going to use. It's Portfolio Visualizer. It's how you allows you to back test. And of course, my settings are starting with $1,000. And each portfolio contributing a fixed amount every single month. There's no rebalancing. There's none of that. We reinvest dividends, absolutely. And we're going to display the income and all that. So, again, Coca-Cola, QYLD, and SPY, which is also the S&P 500. You just got to remember, Coca-Cola is part of the S&P 500 as well. So, when we're coming down here to look at these, and I think this is something a lot of people really should look at, is KO actually ends up being the worst since 2014. Again, it only goes to 2014 because that's when QYLD, I think, was incepted, if I'm not mistaken. Let's see if we can actually look this up really, really fast. You guys know I love using this tool right here just in order to see the dividends history and be able to go through it all. So if you guys don't know how to do it, you're literally watching me right here do this live. It's dividend history over here on the left hand side, and then you can go back through here, and it does look like it's going to be 2014 when it was incepted in January of 2014. So then we just go back to our back test, and Coca-Cola obviously coming in at 70,000, almost 71,000. We'll round that up, and then QYLD ending up at 72,000, which is technically higher. So you're going to get just a slightly higher return. And then SPY is almost at 95,000. We're actually going to round that one down to 94,000. So, and then we look at the chart, obviously, with portfolio growth. And they're very, very close, actually, when it comes in. We could have saw that, obviously, from up here. But the thing is what are you going to make then? If that's happened all these years, what are you making? And it really comes down to, which one do you want? Do you just want your retirement income to keep growing? Or do you just want your portfolio to just continue to grow no matter what? You just want to invest into instantly solid companies that you absolutely love and that you use every single day? Or do you want it to grow monthly and have that compounding effect a little bit faster and have that monthly income? Because Coca-Cola, you're only going to get paid once a year or 4 times a year during dividends, and that's it. And then the rest of it is just from, of course, appreciation of the stock. Rather than QYLD is going to get you some appreciation, but a lot of it's going to come from the income part of it. And again, obviously, you see here, you're almost going to have, we're going to round it down to 4,500. Coca-Cola is not even going to make you $1,000. We'll give it the extra dollar and make it to $1,000. And then SPY is even less, of course, at $556. So basically $550. But QYLD is really going to be that one to get. And I'm not saying one is absolutely better than the other. Everybody has their own thing. And a lot of people, what I have found is you're doing both of them. So not only do you have to buy a Coca-Cola or a QYLD or something like that, you can have both of them in your portfolio. I think it's actually very smart to diversify and have a lot of income and to have these solid brands. And Johnson & Johnson is another one. So not a lot of people are going to, or a lot of people actually talk about this, but a lot of people get discouraged with this $173.66 price point. I don't think it's anything to be discouraged about. It's a solid company. You see Warren Buffett and people like that always buy into these companies all the time just because it's a solid company. They make a ton of household items and consumer goods that people are going to use forever. Soap. Everybody needs soap. If you don't use soap, well, you need soap. Just know that. And it's the same way. So again, this is as easy as this is we're just going to go over here to Johnson & Johnson. It's going to pop up JNJ, and we're just going to replace it. And let's just see what this is. This was not planned at all part of this video, but knowing that you can go through and look at these, and you're going to see JNJ actually outperforms QYLD just barely. So again, but it's within a few $1,000s of every single one of them. SPYs obviously outperformed them all. But again, do you want the income? Because the only red bar here that's huge is QYLD and giving you that income. Now that one is completely up to you. Now if QYLD, again, stays on track and everything, I do believe that you're going to see a lot more growth. If we could take this over 25, 30 years, I think it would be greater data showing that, you can retire probably a lot faster. Because if this is $5,000 and you let it keep compounding and you're reinvesting an extra $5,000 to $10,000 every year, because this one's only at $5,000, what was it last year? Yeah, almost $6,000, and you're reinvesting a free $6,000 every single year, you're going to be able to retire a lot faster than what you think with a lot less. And I think that's what a lot of people are really wanting to do. So with that being said, thank you guys all for watching this video. Make your own decision. Make sure you do your own research. And I think that's the biggest point of my videos is making sure you're doing your own research and knowing exactly where you need to be. So with that being said, thank you guys all for watching this video, and I will see you guys in the next one.